MF Global explained the $1.6 billion mystery of Jon Corzine's collapse. When a financial company mishandles tens or even hundreds of millions of dollars, outrage and investigation inevitably follow. But in 2011, MF Global lost something far more staggering: $1.6 billion in customer funds. This wasn't a minor accounting error or an isolated rogue trader scandal. It was a colossal failure of risk management and governance involving one of Wall Street's most prominent figures, Jon Corzine. The fallout rippled across global markets, shook trust in brokerages, and exposed gaping holes in regulatory oversight. MF Global's implosion is a gripping story about how political power, risk-taking, and poor controls combined to debilitate a respected financial firm. To understand what happened, we need to trace its arc from a rising star of Wall Street to a warning beacon on regulatory and risk management failures. MF Global was no ordinary firm. Founded as Man Financial in 1989, it focused initially on futures brokerage and derivatives. Over time, under various leadership teams, it expanded its footprint, building a specialized niche connecting institutional investors to commodity and financial derivatives markets. By 2010, MF Global was a $41 billion firm with a substantial presence on the New York Mercantile Exchange and clients ranging from hedge funds to sovereign wealth funds. What truly set MF Global apart was the leadership of Jon Corzine. Corzine wasn't your typical Wall Street CEO. Before taking the helm of MF Global in 2010, he had been a U.S. Senator for New Jersey and served as chairman and CEO of Goldman Sachs, one of Wall Street's most influential banks. His political and financial pedigree made his transition into the role a major event. Corzine envisioned transforming MF Global from a niche derivatives broker into a full-scale financial powerhouse, particularly by expanding in European sovereign debt. This ambition, however, would be the catalyst for the catastrophe. At the heart of MF Global's collapse lies a risky bet on European sovereign bonds. During the European debt crisis that ramped up in 2010 and 2011, countries like Italy, Spain, and Portugal were seen as highly vulnerable to defaulting on their debts. Yet, for MF Global, these high-yield European government bonds represented a way to generate outsized returns. According to the Securities Investor Protection Corporation, SIPC, and the Commodity Futures Trading Commission, CFTC, investigations following the collapse, MF Global had accumulated roughly $6.3 billion in European sovereign debt by late 2011, much of which was highly leveraged. Now, why was this problematic? For one, MF Global used customers' segregated funds to finance these risky sovereign debt purchases. Segregated funds are money that clients deposit for futures trading and must legally remain separate from the firm's assets. Brokerages are required by law, under the Commodity Exchange Act, to hold these funds in special accounts to protect customer assets if the firm becomes insolvent. Instead, MF Global transferred nearly $1.6 billion from these segregated accounts to pay for the sovereign bonds. This is a direct violation of client fund protections set by the CFTC and SIPC regulations. In other words, MF Global was illegally using customer money to finance its own risky investments. This misuse went on for months in 2011, when turmoil in European debt markets worsened and liquidity dried up. When MF Global's bond holdings started losing value rapidly, creditors and counterparties became nervous. The firm faced significant margin calls and plummeting asset values. On October 31, 2011, just as markets were opening, MF Global filed for Chapter 11 bankruptcy protection. This filing sent shockwaves across commodity markets because MF Global wasn't just any brokerage, it was a primary clearing firm. Thousands of customers worldwide suddenly found their accounts frozen or inaccessible. In the weeks following, regulators and trustees scrambled to reconcile $1.6 billion in missing customer funds. These funds should have been safely segregated, yet after an inventory, there was a multi-billion-dollar shortfall. According to the SIPC trustee, as of early 2012, $1.6 billion worth of customer money was missing, representing one of the largest customer fund gaps in U.S. financial history. How could such a fundamental breach occur? To understand, we need to examine MF Global's governance and risk practices. Jon Corzine's leadership style played a key role. Coming from Goldman Sachs, he was known as an aggressive risk-taker who pushed MF Global into uncharted territory. He bet heavily that European governments, despite their debt crises, would avoid default. Moreover, the firm's internal controls weren't set up to prevent or detect the illegal commingling of funds promptly. According to the CFTC's 2013 report, MF Global's compliance department raised questions multiple times in late 2011, but was overruled or ignored by senior executives, including Corzine. The firm's treasury management system was described as chaotic. MF Global reportedly used complicated internal accounting practices that obscured the movement of customer funds, enabling the illegal transfers to go undetected for months. Transparency was a casualty of poor management and inadequate regulatory oversight. Federal regulators launched multiple investigations into the collapse. The CFTC, the SEC, and the U.S. Department of Justice all examined whether criminal charges were warranted. In March 2013, Jon Corzine appeared before Congress denying intentional wrongdoing but acknowledging serious errors in judgment and controls at MF Global. Corzine attributed the failure to a perfect storm of European debt volatility and market dislocations. He insisted there was no fraud or theft but accepted responsibility as CEO. Despite the fierce investigations, no criminal charges were filed against Corzine. However, in January 2017, the Commodity Futures Trading Commission fined MF Global $100 million for improperly using customer funds and charged Corzine personally with supervision failures, imposing a lifetime ban from supervising futures brokerage firms. From a regulatory perspective, MF Global's collapse exposed glaring weaknesses. The Grain Futures Act of 1922 and its successor laws intended to protect customer funds in commodity futures trading had largely relied on broker self-reporting and periodic audits. MF Global showed how vulnerable this framework was when a firm's top executives deliberately bypassed controls. In response, the CFTC introduced new rules in 2013 to strengthen segregation of customer funds and improve transparency. For instance, firms now had to reconcile customer accounts daily and provide regulators with real-time reporting on funds movements. The SEC and Justice Department also beefed up their oversight of futures brokers with tighter examination and enforcement powers. The broader financial industry paid close attention. MF Global's implosion was not unique in showing how dangerous it can be when firms use client money to backstop risky manipulations. The Lehman Brothers bankruptcy in 2008 had similar themes of liquidity crises, risky asset bets, and inadequate oversight. What makes MF Global especially notable is that it involved a former Goldman Sachs titan with deep Washington ties. Jon Corzine had been Treasury Oversight Chair in the Senate and was New Jersey governor before returning to finance. His fall served as a stark reminder that political pedigree and experience don't immunize an executive from catastrophic risk-taking or regulatory breaches. The collapse also had real victims. Thousands of MF Global's customers, including farmers, pension funds, and trading firms, experienced delays, frozen assets, and uncertainty for months. While CIPC and bankruptcy courts eventually ensured most customers were compensated, some lost millions due to trading losses during the chaos. One survivor account detailed how a small Midwest grain elevator relied on MF Global to hedge crop prices for years, only to see their accounts frozen for weeks in 2011, creating severe liquidity challenges. Others recall weekend phone calls with lawyers and trustees desperately trying to sort out frozen trades. The MF Global story underscores a fundamental risk in financial markets. When trust in the safekeeping of funds is broken, entire segments of the economy that rely on hedging and risk transfer are jeopardized. Commodity markets underpin global food supplies, energy delivery, and industrial production. Without confidence in brokers, these markets lose liquidity and efficiency. Looking at the timeline, here's how the key dates align. Early 2010. Jon Corzine joins MF Global as CEO, setting plans to expand into European sovereign debt. Mid-2011, MF Global ramps up purchasing European government bonds, funding much of this with customer-segregated funds. October 31, 2011, MF Global files for bankruptcy after facing liquidity shortfalls and margin calls. November 2011, early 2012, $1.6 billion in customer funds found missing in segregated accounts, triggering investigations. 2013, CFTC fines MF Global $100 million, imposes lifetime ban on Corzine from brokerage supervision. 2017, Corzine formally barred from futures brokerage leadership. The amount $1.6 billion sounds abstract until you consider it in terms of everyday impact. For example, U.S. farmers rely heavily on hedging futures contracts to protect themselves against volatile crop prices. Losing access to funds in the midst of the planting or harvesting season can mean the difference between profit and bankruptcy. Pension funds rely on size and stability to ensure beneficiaries receive promised payouts decades later. For them, frozen or lost money threatens retirees' livelihoods. After MF Global, regulators realized voluntary compliance and delayed audits weren't enough shields. Real-time surveillance, stronger segregation enforcement, and harsher penalties became necessary to restore market faith. The MF Global saga is a cautionary tale about hubris and greed cloaked in political prestige. It reveals how even seasoned leaders can fall victim to overconfidence and how fragile the foundations of financial trust can be. At the end of the day, MF Global's collapse was a failure of both corporate governance and regulatory oversight. It shows us that when customer protections are circumvented, the ripple effects reach far beyond balance sheets. They shake entire economies and the lives of everyday citizens who depend on stable markets. The mechanics here were almost laughably simple. The illegal transfer of segregated funds to fund risky bets, a violation known to every futures firm that operates within the Commodity Futures Trading Commission's jurisdiction. Yet the scope and duration of MF Global's breach went undetected until it was too late. For investors and policymakers, the red flags were buried in plain sight in the form of rising European debt risk and the firm's increasingly aggressive balance sheet. But the mix of complex financial products, lobbying influence, and confident leadership masked these dangers until the collapse forced a reckoning. MF Global's downfall remains a case study in what can go wrong when blurred lines between corporate risk-taking and client fund protection collide. It's a stark reminder that even in the age of complex derivatives and high finance, some foundational rules, like keeping customer money safe, remain non-negotiable. The lessons from MF Global continue to resonate. As global markets face new crises, from trade wars to pandemics, trust and transparency will remain the linchpins that hold the system together. When those are compromised, the fallout can be swift and severe. Exactly what we saw with the $1.6 billion lost under Jon Corzine's watch at MF Global. If you found this story interesting, hit that like button and subscribe so we can keep making these videos. Tomorrow, we are diving into a story that is just as shocking. Refco, the $430 million hidden debt that collapsed a brokerage. You will not want to miss it. I will see you there.